Welcome in to the Lance Roberts Show.
Welcome to the show today. I'm your host, Lance Roberts. Today's show being brought to you by Whitsitt Vision Center, of course. Get by their website, whitsittvision.com. Check out Dr. Jesse McKee for all of your vision needs. They do a fantastic job of restoring bad vision to good vision. So if your arm is simply not long enough anymore to, read your phone, he can fix that. He fixed my vision and Brent's, and of course, having perfect vision is a great way to lead life. Go to the website, whitsittvision.com. Schedule your appointment today. It's absolutely free for your initial checkup. Let's talk about the show today. Markets are wrapping up the close right now. The Dow did finish up about 23 points. It's still settling out, so these numbers are going to change here over the next few minutes. But the S&P was down 8 today. The NASDAQ down 96. Here's the interesting thing. The market's been pulling back here over the last couple of days, and we actually touched support today at 28.82, and that's a kind of a key critical support on this pullback. The market's bounced off of that today, so we'll see if the market's going to hold this level over the next couple of days. We have been selling off now for the last really kind of 4 days. Things that are going on here, importantly, though, is that we have established a short-term top in the market. Now, the market was, and I talked about this a bit yesterday during the market wrap, is that the market had gotten previously pretty overbought here. And it was likely, we talked about this last week, that a pullback, a short-term pullback or some corrective action would be needed to basically add more money to portfolios. So ever since these previous lows that we had back in April and May, we've been adding exposure back to portfolios after we'd reduced exposure back in early February to protect capital during that decline. But since we've been adding this back in, we've been using these breakouts of previous resistance levels to add exposure to portfolios. So we've been continuing that process. When we broke out to new highs, we talked about the fact that, with the markets now breaking out to all-time highs, this is great. It confirms the bullish trend. We definitely want to participate with the markets, but the markets, by the time they break out in something like this, the markets are typically very overbought. And we said, hey, be a little patient here. We're going into the month of September, and it's very likely that we're going to see some type of little short-term pullback that will allow us to add some exposure to portfolios. And that's what's really been happening over the last few days. So what we need to see here is this market continue to hold support here right at 28.80. I mean, this kind of that 28.80 level is kind of a key critical support. That is a confirmed breakout of the previous high. So we're coming back, retesting that previous breakout. That's bullish, and as long as we hold here, that's good. We are working off this overbought condition as well, which existed from that previous run up, and we're now getting back to a little bit more of an oversold condition here that psychologically may set up well for traders to come in, put some money to work. Now, mind you, that this is all very short-term stuff that we're talking about. As a trader, this is what you want to take a look at, these very short-term movements in the markets and really understanding what the dynamics are here. We're moving into the month of September. We had 2 strong months in July and August. So there's a lot of potential here that the month of September could be a bit of a rough month, basically kind of tread water back and forth, not do a whole lot. But potentially that would set the markets up for an end-of-the-year run. So the typically strong period of the year begins in October, runs through March, April of next year, and typically that's where the bulk of markets gains tend to be made. And of course, we saw this last year. We had the run in October, November, December, January, and then the rest of the seasonally strong period turned out to not be so strong. So we're playing a little bit of catch-up here over the last few months. But if we move this out, and as we talked about this a little bit yesterday, on a longer-term basis. Now, for longer-term investors, and again, we've been long-term investors here for the last few years. We've had money exposed to the markets. We continue to keep money exposed to the markets because the bullish trend remains intact. Despite the ideas that we are very late in a bull market cycle, there's no arguing that point. The fact that we are have a very excessive level of valuation, second highest level in history. There's no arguing that fact. That doesn't mean that markets are going to crash tomorrow. It doesn't mean you should go panic and hide and put all your money in cash and wait it out. That simply doesn't work out well. As long as the trends are positive, and they are, and there's been no evidence here on a weekly basis or even a monthly basis that there's any risk of a bear market starting tomorrow, we want to keep money exposed to the markets. As long as the trend is positive, we want to remain invested in the markets on the long side. However, ultimately, what will happen at some point, and this happened in 1999, 2000, happened again in 2007, it's happened throughout history, this positive trend will eventually become negative. And when we begin to break this bullish trend, in other words, when prices are no longer rising at basically this 45-degree slope, and when they begin to go in another direction, that's where we'll start to seriously talk about removing cash from the markets, raising cash, being more defensive, being more selective about where you're putting money. But that's not now. That's not today. It is important to know that the markets are extremely overbought on a longer-term basis. If we take a look at long-term deviations from trends, we take a look at earnings deviations from trends. We wrote about this on Tuesday on our website at realinvestmentadvice.com. There's plenty of evidence that we are in a very late stage cycle of the market, so we definitely want to be aware of that. But again, that doesn't mean that we go hide in the bushes today and wait it out, because markets can remain irrational much longer than you can remain solvent. And what happens for a lot of people is they typically get out of the market under some threat of concern, and then they get sucked back in because the market keeps going up, and they typically get sucked in right at the peak of whatever the top of that market tends to be. And this is why investors historically, they buy high, they sell low. It's part of the psychological behaviors that make up investing. And of course, we haven't made this any easier on investors. I've got an article coming out next Monday talking about psychology and investing. And the one thing that we've done very successfully with the markets is we've turned this all into a big video game. So every day we've got, arrows pointing up, arrows pointing down. We've got red lights, green lights. We've got all these things that are flashing going on. We've got them on the Wall Street, at the New York Stock Exchange, clanging gavels. We've got Jim Cramer on the air, bulls and bears and whistles and horns. And it's all exciting. It's all fun. And it feeds that dopamine effect for investors, right? I've got to be in. I've got to make money today. I'm going to go home and check my computer. How much money did I make? But those type of actions deter you from making long-term good investment decisions. Bringing all that emotion into your portfolio management structure always turns out badly. One, it wears on you psychologically, but two, it also impacts your money. So this is why we talk about these things and these long-term trends, and we keep a watch on these. But importantly, in the short term, we want to pay attention to where the market's headed. Now, and again, as I said, this opportunity that we're having now with this pullback will likely give us an opportunity to add some exposure to portfolios this week. And when we do, we'll certainly update you on that. I did want to bring your attention to a couple of other interesting things that are going on right now. You take a look at bonds, despite the fact that we have all this stuff going on in the markets trading all-time highs, and of course the issue with talking about trade and tariffs and trade wars. And of course, for the last 5 years, every bond manager on the planet has talked about higher interest rates, how we're going to go to new highs on interest rates. They're going to keep going up. And we've talked about this the last couple of years. There's really no evidence of that being the case. And interest rates on the 10-year Treasury remain really confined below that 3%. And in fact, every time we get above 3%, it winds up impacting the stock market. Because again, if you remember, interest rates are a function of consumption. And it's interesting to take a look, for example, right now with automobile loans. Automobile loans are now on average about $525 a month. So when you start moving car loans up to a point where payments exceed the ability of individuals to make those payments, you see a slowdown in sales. Like auto sales have been slowing down. Home sales have been slowing down the last several months. Why? Because mortgage payments are now going up. Rent as a percentage of total income is now at one of the highest levels that's ever been in history. So affordability, real affordability, becomes a much bigger issue. When you look at a lot of the stats that are put out by different agencies, they'll talk about, well, affordability for homes is at historic lows, and debt as a percentage of disposable income is at the lowest level it's been since 2000. Well, the problem with all those data points is that it's heavily skewed by those at the top end of the income cycle. So in other words, the top 1% of the economy that owns basically the majority owns half the wealth of the entire economy, it skews all those data points. When you start looking at the 80% of individuals that are living paycheck to paycheck, we go through all these stats talking about savings and retirement and how much people have in 401k plans. On average, about $26,000 to say that they've saved actually to retire on. And you start to understand the fact that rising interest payments, rising mortgage payments, rising rent payments, those don't really give a lot of room for most individuals to have that wiggle room. And that's why we see so many individuals living paycheck to paycheck, not investing, not saving money, because it's taking literally everything they have just to make ends meet. Okay, we're going to come back after the break and pick up with Richard Rosso and Danny Ratliff, certified financial planners. We do have to talk a little bit about retirement, speaking of, and Social Security. So hang on, we'll be right back.